Great. So really turning over to the first page, and then I'm going to turn it over to my colleague Neil to talk about the individual investment accounts. There's a QR code right there. We do publish quarterly investment information about the markets, about our funds, and so forth. So if you scan the QR code, you can get access to that. Also, some of you may be receiving our quarterly investment updates, especially if you are clergy or part of this board, you likely receive those. And if you'd like to receive them, I think there's an area on the website you can sign up for it, or just let Dustin know and we can add you to that distribution list. So with that, I'll turn it over to Neil, and unless you have anything to add.
Yeah, sure. The only thing I'd say is I thought the quarterly investor letter, it came out earlier in July. I thought it was really well done. A lot of great insights. It's been a quarter dominated by market headlines, and yet, the market has continued to trend upward. So we have some thoughts on that, but if you haven't checked it out, I'd recommend you doing so. And something I heard recently that I wanted to share with you all is I heard the US economy being compared to the human body. And every human body has a six-pack of abs.
Does everybody have a six-pack of abs?
Whether you can see it or not.
It's whether you can see it or not. It's the layers over that muscle that prevents the abs from being seen. So heading into April 2nd, Liberation Day, a lot of industry experts felt very strongly that the U.S. economy had a six-pack, and it's just that these tariff announcements and the walking back of the announcements, but it's lent a layer over this six-pack of abs. And so now, as progress is made, as we strike deals, as we've done with Europe, South Korea, Japan, and more just yesterday ahead of this August 1st deadline, as that happens, we're starting to chip away at that layer there and starting to be able to better see that six-pack of muscle and really more on that golden path to 2% inflation. Because again, with that six-pack, they were trying to say that the labor market looks good, jobs look good, on that path to 2% inflation, but we had some roadblocks here with that extra layer. And lastly, this is just a point I'd love to mention is that I also read that imported goods only account for 11% of US GDP. So yes, there's rightful to be concerned about tariff news, but at the end of the day, there is a chance there'll be less of an impact than initially expected because of that 11% lane and saying, it is a small part of GDP. All right, Dustin, we could hop to slide 4 here. And the foundation ended the second quarter in aggregate at about 71.5 million. And that was led by that dark blue shade of the pie, which is the Kansas Balanced Fund. That represented about 66% of total assets. And right next to it is a light gray slice of the pie representing the Kansas Fixed Income Fund. That represented about 13% of total assets. And these figures, this aggregate of 71.5 is up from 68 million at the end of the first quarter. And slide 5 here is our first look at performance. So let's hone in on what happened during quarter 2.
One thing I'll add just before we move on. This account was invested in the multiple asset fund, and then we made the change in October 1st of 2024 to this outside allocation. So the difference between the multiple asset fund and this new allocation is we no longer have the inflation protection fund, which previously was 10%. It's no longer part of the allocation. And then we added in the US equity index fund. So part of that was to, in that US equity fund portion, make it more market-like. So remove some of those biases that we had that were detractors in the US equity fund. And then we lowered the international allocation by 10%. Again, made the balance fund a little bit more in line with, I would say, investors' expectations, and where we feel international markets had not performed at the time as well as US markets. So lowered the allocation and brought in the market the US Equity Index Fund, which is the Russell 3000.
And of course, international markets outperformed US markets in the first half of 2025.
They did, but I don't feel like,
We still kept a good.
I mean, part of that, and two, and then I know Neil will talk about it, but your returns for quarter year to date and the quarter year to date were better than the multiple asset fund had performed because of adding in the Russell 3000, the index fund. So it did do better. But again, I think the decision was made, and we continue to have these conversations. When we make allocation changes, we're not making it for like the next 3 months, the next 6 months, the next 9 months. I mean, this is something that we had thoughtfully discussed with the when we meet in person annually. We look at the allocation and where we want it to be positioned for the long term, given what's going on in the markets. What the committee, their feelings of certain asset classes, international versus US, inflation protection versus fixed income. And so when we make changes, we make them for the long haul and not trying to time them for where we think the markets will go. The timing did seem ideal, especially given new administration coming in, a lot of talks about tariff, a lot of US focused discussion. So just assuming with all of that, you would think that the US markets would continue to dominate. But again, we saw a weakening dollar. The valuations internationally were really attractive, and they just kind of boosted in the first few months of the year. But then we are seeing them pull back some. So again, we make decisions, it's for the long haul, and it's just timing's never ideal, but and that's exactly, but just wanted to point out the change in the allocation. So sorry, Neil. Go
Yeah,
ahead.
that's great. Thanks, Karen. But no, a healthy quarterly return that you'll see that 7.3% for the balanced portfolio versus a benchmark return of 8%. Just a reminder, all these returns are always net of all fees. So that's administrative, custody, and investment management fees. And so looking at those returns, I think there are a couple of stories here. The first is from an absolute return perspective. Well, where did that 7.3 come from? It largely came from the equity funds. International was up 11%, the US equity index up about 11%, and US equity up about 8%. The other story is the relative return. So about 70 basis points under benchmark here. That also was driven by the equity funds, specifically international equity, which was about 150 basis points under benchmark, and the US equity fund, which was 270 basis points under benchmark for the quarter. Again, certainly not where we want to be on a relative basis, performance-wise, but to that point, we have a lot of confidence, and we're really excited about the changes that Quach and team have made with the US equity fund and the underwriting of the fund. Changes that I'm sure you've spoken about in prior quarters that are starting to take place and be implemented.
One thing before we go to the next fund. You likely recall when we were doing these asset allocation analysis, the expectation is this fund would return around 7% net of all fees. And that's exactly how it has performed if you look at that inception to date number. So we've pretty much hit the target based on the return expectation of the balanced fund. As Neil mentioned, and as you hear in the market headlines, and as we've reported in our quarterly meetings, is especially in the US space, which this has a higher allocation to US, the market's been really dominated by a handful of names. And our US equity fund is underweight those names, but the benchmark has full market weight of those names. So us trying to underweight these Magnificent Seven, these mega cap names, has been a detractor. But we also learned that 80% of other active managers are also underweighting these names as well. So when we look from a peer perspective, we look a little bit different than how we compare on a relative basis, because we pretty much are, the way the fund was structured is similar to what other active strategies were doing. But the committee as a whole made the decision to add in the benchmark to kind of lessen that underweight that we have to those large 7 names, and that's worked in your favor. And also I misspoke. You've been outperforming the multiple asset fund on the 1, 3, and 5 year. You've detracted in the near term because of the international equity fund lesser weighting. So over the long term, you lessening international, adding in the index has helped. It has not helped in the near term, just because, again, we've seen the international markets outperform US in the near term. Any questions about the balanced fund? I know this is where the bulk of your assets are. I know where a lot of your investors are invested.
Yeah, most of our church accounts are in the balanced fund. Not all of them, but the bulk of them are. There's a few who have, unique timing issues or preferences of other sorts. So, yeah.
Can you explain the bottom chart here, the account asset growth
Yeah,
in relationship to the performance? Because if I look from December, I might be misinterpreting this, December 24 to June 25, it looks like it's taken a drop.
the markets did dip in the beginning.
That's more about the accounts that
Yeah.
we steward. So we had a large partner that needed funds for ministry, and so they pulled a fair large amount. So it's not about performance, it's about our account balance.
Okay.
And then we had a few other churches that changed their asset allocation, so that makes a difference too. So
Okay.
it's not really easy to track,
Performance
why, but it's not performance based.
I
Yeah.
was trying to make an inappropriate comparison here, like,
Yeah.
sorry, I'm a visitor.
No.
And part of it was the markets too. I mean, we did see the markets drop in the first part of the year, given the noise of like the tariff talk and so forth. So part of it's, I think, withdrawals and movements in investors, and then part of it in the beginning was some market impact as well.
All right, do you want to flip to slide 6? Perfect. All right, so slide 6 is the Kansas Fixed Income Fund. Again, if we hone in on that second quarter performance, you'll see a modest return of 2.3%. It did outperform its benchmark by about 75 basis points. So I think the thing to keep in mind here is that quarter 2, as we've been speaking about, it did include Liberation Day and all those sharp bond market volatility spikes. There was a time there where fixed income was trading like risk assets. So if we take that into consideration, you think about an absolute return of 2.3% for fixed income for the quarter. I think most investors would be pretty pleased with that return.
This fund,
4.9. We haven't been there in a long time.
yeah, and this fund's 100% actively managed. PIMCO is the largest piece of the pie, I guess, who manages this part of this fixed income fund. And PIMCO strategy is a core plus strategy, so they can kind of go in and out of different sectors of the fixed income market. And then we also have some non-dollar allocated bonds as well. And those non-dollar bonds have done well given this decline in the dollar that we've seen. So it's about a 10 to 13% allocation to non-dollar bonds. And just the structure of this fund has done well in this pretty challenging fixed income market that we've seen kind of at the start of 2022 with inflation until now. But I think the big thing with bonds in general will be, what will the Fed do in September? Are they going to cut rates, leave rates the same, or so forth? So again, that's probably something that our PIMCO, I know, is honing in on and paying attention to. Any questions about the fixed income fund? Okay.
All right, let's move to slide 7, the Kansas Equity Fund. Quarter 2 performance and absolute return of 9.9% versus its benchmark of about 11.5%. So this slide, I think the story here is the dynamic within equities. So we've talked a little about the US versus international debate. This particular portfolio here is 70% US, 30% international. Well, we know that heading into the start of this year, US had outperformed international equities for, 15 straight years or so. And so it was just the start of 2025 where now we've seen year to date, as of end of quarter 2, international has outperformed US by about 12%. And if you looked a little bit earlier in this year, that number, it ballooned, it was about 15%, that gap between international and US. So we know at some point international will have its day once again. It may be having its day right now with everything Karen mentioned and the sentiment around the US. So international, that's one dynamic to keep in mind. But then there's also the active passive debate that we talk about. And this portfolio split. It does have that split with the equity index fund. And again, it's a similar story to US versus international. Active management will too have its day once again. We don't know exactly when that'll happen, but I feel like it's been somewhat of an unfair fight over the past 2 years because of that really concentrated equity market that Karen spoke about, where the Mag 7 or at times one or two names single-handedly moving the US equity market. It's kind of been an unfair fight for active managers. So at some point, we do expect that to change, and something to keep an eye on.
Yeah, and one thing too, we did have some allocation changes. So when the foundation originally hired us, we were 55% of this fund was US and 45% was international. So it was almost equal weighting between US and non-US. And then in 2022, we added in the index fund and we lowered the international allocation. And then we did that again this past fall when we adjusted the balance fund. So international equity fund went from initially 45% to 35 and then to 30. So again, we've gradually been decreasing that international allocation. The main reason for the underperformance relative is one, as Neil mentioned, in the US space. Also in our international equity fund, it's about 85% actively managed. Heading in, those of you that were part of the committee when Wespath was hired, our international equity fund had really strong outperformance. Our managers were just going gangbusters when it came to picking those international stocks. And what happened during COVID was we really started seeing a shift in the international equity fund managers where they, when you set up a fund, and why we'll talk more about this, but kind of setting the stage for that conversation is you want your managers to not act the same. So when there's an up market, you do want some ballast so that they're not all performing the exact same way, because you do want some of that ballast in your portfolio. Well, coming out of 2020, when we saw this big tech boom in the US, everyone's going remote, AI, sort of the birth of AI, artificial intelligence, kind of shifted the market in the US, and it also shifted the market internationally. So our international equity fund became a little bit more growthy in the names that our managers were picking, because again, it was primarily actively managed. So managers that were uncorrelated started to become a little bit more correlated. And this is something that we've been monitoring within the fund. So part of the work that we've been doing the last few years is Juan and our team have traveled the globe, meeting with our international managers, because not all of them are in the US. Meeting with the team, looking at how they pick their stocks, how they measure stocks, and so forth. And part of the work that we're doing is we will have some managers replaced in the fund, because some of them, again, they kind of move in lockstep, which is not what you want for our fund positioning. Also, unlike the US, international value has done really well. And our fund is underweight value because of the names that our managers are picking. So again, we're really trying to work on that fund structure, look at the manager names. It's not going to be a complete overhaul. It's going to be a few names that we will be replacing within the fund. And unfortunately, we can't mention those names yet because they have not been informed yet that they will be getting replaced. But that's primarily what's happening in the international equity fund, is we're replacing some of the things.
Yeah. The percentage of managers that you're looking at changing over.
Just from a fund construction standpoint, we want to look at the conviction and that we have in the managers. I think there are some managers that we like. We don't necessarily want to overhaul the entire fund. But as I look at the managers in there, I definitely see room for improvement in many of it. I think there might be some significant changes in international equity fund. Just as Karen said, the managers in there, they're not that differentiate from one another.
Yeah.
And
so a lot of overlap in some of the names that they're.
So there could be a significant amount that is replaced. I don't have a specific percentage. We're still working through that right now, trying to understand how we want to allocate within the funds and what managers that we have high conviction in. But if, for the US equity fund, that is where we're pretty much done in terms of how we want to restructure the fund. And that was, we haven't changed the overall number of active managers, but we are replacing about half of the active managers that are in US equity fund.
Yeah, which we'll talk a little bit more about the changes that's getting done in the US equity fund. But yeah, primarily in the US space, a lot of it was our overweight to small and mid cap and underweight to the mega caps. In the US, in the international fund, it was purely investment managers. And we're not looking to have like a strategic overweight to frontier emerging markets or being tactical in that space. It's just doing we call re-underwriting, which sounds like you're re-underwriting your insurance policy, but really just re-underwriting our conviction in the investment managers and some managers we've had since the 1990s in the portfolio. So coming from Mercer and then was at Mercer in manager research and then worked for Christian Brothers, which is the Catholic entity, very much like Wespath. Had a lot of names that she'd been monitoring and watching over the years. So bringing in fresh names for our investment team to meet with and see if there's a place for them to be added to the portfolio.
And it sounds to me, your analysis of your managers is not just outcome, but also their process, that you're really analyzing their process and whether you have a conviction in how they're.
Right, because to me, outcome is what's already happened. You can't invest in what's already happened. You can only invest in your expectations for the future. So what we want to do is make sure that they have a strong process. They have a team and they understand what they're trying to achieve in the market. Is there something that they think that some market anomaly that they can take advantage of? And do they have a process that lends them to be able to repeat that? So it's like what we're trying to do is to invest in managers that we think have the highest probability of outperforming going forward. And the outcomes are definitely a part of that, but it's that expected performance. There's going to be times where the managers underperform, and if it's in line with what we expect, we're comfortable with that. It's so when I think Karen was talking about when the International Equity Fund did start gangbusters, everyone outperformed. I'm probably more suspicious of managers when they outperform when they shouldn't be, as opposed to managers that are underperforming.
Because it meant that they just followed the trend.
They could have been doing something.
Without their process.
And it's exactly what we started seeing in the international space. And a lot of the work that's been going on has been trying to understand like the repositioning of the portfolios. For instance, we have one manager that was overweight China, which helped its portfolio prior to 2020. But then as everyone knows in COVID, China took them a lot longer to reopen their economy. So their companies didn't, and that just really hurt that manager. And then they got out and then China reopened their economy and started doing really well. So it was one of those, like, what is your process internally for picking names and holding on to them? And one of the things Quach has said that really I never thought about, but then now that I'm sitting in manager meetings, it kind of picks up, where it's like making sure the investment team is not falling in love with particular names, because then that can really, glamour you, where you're like, well, you don't know when to sell it then, because, maybe the metrics are there, but you're so in love with this company that you just don't know when to let go of it. And that was never really thought about that. Also, with the change in our chief investment officer we've had the last 2 years, the prior CIO really favored larger names like the Wellingtons and these really larger companies, where a lot of them are really focused on gathering assets, becoming bigger and bigger and bigger. Where the smaller names, the more niche-y investment managers that maybe you don't hear of every day, are more focused on like generating alpha to outperform their benchmark. They're not necessarily wanting to get bigger and try to like increase the portfolio, but how can we just stay focused on these names? And I think that's been a shift in the last 2 years between the leadership at Wespath as well. And I think when the manager changes occur, I think you'll see that. We definitely will still have the larger names like the BlackRocks in our portfolio, but you may see some of these not your everyday household names. Or are the advisors in the room maybe have heard of some of the names. But any questions, because I do, it's not that we want to skim over performance. We've always prided ourselves in being fully transparent on, what's worked, what hasn't worked in the portfolio, and then moving forward, Wah and her team and the work that's getting done. Garth, you had a question?
Yeah, I think it fits in here. We seem to be in a time of intense political divides or perspectives. And I wonder what, if any, filters there are in evaluation of managers to get a sense of political influence either way on investment decisions.
Like if someone's like pro current party, maybe they'll be trading differently, own different names, or maybe how they feel about the economy going forward. Is that what you mean?
Some real intense happening going on that I think can impact investment decisions. And so I wonder, in your industry, are there filters that look for those kinds of biases?
Well, I don't know that there are necessarily filters, but this is where we think that, discussions with the decision makers in the funds are very important. And this isn't just a one-time discussion that we have with them, but it's having enough experience to say every quarter we meet with our managers, just understand their decisions, how they make decisions, and you can get a sense of what's driving it. And what we look for are different people in the team that have input into how decisions are made and having different perspectives. We find that that's really important. You don't want everyone just to be parroting what the portfolio manager is saying, but that you want true debate, challenge, and making sure that robust decisions are made. And I think I don't think that you can necessarily get away from bias. Everyone, as they go through life, they have certain biases, and that comes through in the portfolio. The decision makers in a portfolio, where they went to school, how they grew up, their family dynamics, that all plays a role in how they make decisions. So it's important that you have people from different backgrounds, different viewpoints, different experiences, having that input into the decisions. I don't think we can get away from the bias. Is how you manage the bias
In the process, yeah, to avoid it.
I think another thing you're talking about is political risk. And over the years, we didn't worry too much about political risk in US markets. It was international, particularly emerging markets or frontier markets. What's the political risk of investing in this company in this particular country? And all of a sudden, political risk in the US has gotten a bigger magnitude of risk. And how do they evaluate that? Of course, I don't have any answers. It's up to them. But
I think a good stock analyst actually do understand that, and they do think about that, because I have heard that from some of the managers where it wasn't something that they really thought seriously about in the US, look at US companies, that political risk, but they do now.
Yeah.
And so I think it's making sure that you have good people managing your money that understand all the things that may go into it. So it's part of our investment philosophy is to really look at managers that have really strong and deep conviction in their process, and that they truly are understand what they do. I think to your point earlier about outcomes versus process, I would say I lean more on the qualitative aspects of how managers make decisions when I think about how I evaluate managers, more so than numbers, because I think numbers can hide many different things, but really understanding how they make those decisions is far more important.
I think another piece of where we sit with the risks today, it could be sort of the evolution of why an active manager may be, where you might see active management performance outperform indexes at some point. We haven't seen that in a while either, especially in the large cap space.
And there are, I think, we did this, this little exercise where we looked at what areas of the market is it more beneficial to be passive versus active. And even if you look at, how strong the index has been, and you look at the number of managers that are in there, there's still a good like 10% of managers, even in large cap, that can outperform the benchmark. So there are managers out there that can, and there's some of the managers that we've looked at recently. You look at there's small managers that you probably really haven't heard of, and they have a really strong record because of the way that they think about the markets. And they're not necessarily just overweighting those 7 names. But
And they're able to factor in all those other
Yeah.
aspects happening in our economy.
I mean,
So-
there are thousands of companies out there, and there's going to be some that do really well.
Do you have a question, Phil?
Yeah, just a couple clarifying, did I hear that there was a 50% possibility for manager turnover?
Well, okay, so in our US equity fund, 50% of it is passive, and then we have 50% that's active. And so in terms of, I think the numbers are the percentage of the portfolio, it's about maybe 30% of the assets we're putting with new managers.
So 30% of the assets are gonna be getting some new managers. And I think maybe building off the question of assessing political risk, what fascinating thing.
Mhm.
But I guess my question was, what are and maybe this is building off of that, the moral or ethical or theological considerations for investments? Is that a process that you guys have for there as well?
Yeah, so one of the things with Wespath is our investments are aligned with the social principles of the church. And this is through how we invest, who we invest with, and how we engage the companies that we work with. So we are the only Methodist focused investment manager that incorporates the values of the Methodist Church into our investments. Part of that's through exclusions. So we exclude alcohol, tobacco, gambling, adult entertainment, and private prisons. So even in the index fund, we are excluding those companies. It's really the only index product on the market that doesn't include those companies in it. Also, we do a lot of corporate engagement where we engage the companies we invest in regarding sustainable business practices. And a lot of that is, everyone knows John Wesley was a social advocate. So I feel like it's really bringing in those Wesleyan values into how we are running and managing the investment piece based on that. So engaging with companies regarding labor issues, human rights issues. We worked with the pharmaceutical industry regarding opioids. We've looked at companies like Hershey and where they are sourcing their cocoa from outside of the US and the child labor and so forth. So it's really taking investing just beyond stock picking, but also doing that like advocacy work as well.
So when picking new managers,
Yeah,
you're
so
looking for all this stuff.
but like I think to add to that, so I know in previous there was always this separation between sort of what our managers do versus what we do at Wespath towards aligning with our values, and that we would just exclude certain names from our managers' portfolio. So I actually worked with one of the members of our sustainable investment team in previous firms where we actually worked to integrate some of the sustainability and the manager research, and we work together to find managers that haven't derived a lot of their alpha or value add through investing in these companies that we exclude. So really having more of a proactive, positive approach to hiring managers, like how do they add value? Is it through companies that we are more, that align with our values, or even working with the managers to, have them invest more, to support our values, our causes, some of our engagements. So we're working on a process to further integrate so that it's not like we're just taking a manager, their portfolio is excluding stocks. We want a manager who doesn't need those stocks in order to outperform, and that their portfolio often, however they manage money is very consistent with our values. And, we've done that successfully, like in my previous job with the team. This is where my colleague Lucas and I worked together, and we did, we really started the process to integrate those two facets of the business. And I feel like that was successful, and I think we can do that at Wespath.
And Lucas now works for Wespath.
Can I jump on your tag on to a second?
Please.
Do you see changes happening with who we can invest in? I say we invest in.
Like
Who
in-
you will invest in with the political climate and things. I'll pick on a big topic today, DEI.
Mhm.
You know, that's just one of many. But will that change our portfolios? You foresee?
This is where we try to balance the investment outcomes versus our values. I know like Jake Barnett, who's heads up SIS, we have these discussions quite a bit. It's like, I think it really came to head, let's say, at BlackRock. You know, they've come out, you know, they were a strong supporter of certain issues. Now they've backtracked on that. But at the same time, they have certain services that, you know, that are just more cost effective for us, like the passive management of assets, analytical tools that we can use. So it's one of those like I think what we decided to do is like if we invest at BlackRock, we still need to be able to talk to their senior management and try to, you know, maybe encourage them to not backtrack so much on some of the ESG or DEI issues that come out of that. Like we have our values and we still would rather invest with managers that share our values than not. But we also understand that in certain parts of the market, there may be not a better alternative. And then we have to find a way to at least improve how they think about those things or to further align ourselves, our two firms.
That's a good example, with BlackRock, because I feel like they were so pro on so many issues and then have pulled back on a lot of some of those issues. And again, it's a balance, right? Like BlackRock's one of the largest asset managers, well known in the index space, which that's where we implement them in our portfolio, is in the index space. And then again, other tools. So it's really like a balance. But the good news is with our size and how much money we have invested with BlackRock, typically when we call, they're going to pick up the phone and listen to issues that are important to us. So bringing in the voice of the church through Wespath is something we're able to do because of the amount of assets that we have invested with BlackRock and being a strategic partner with them in some areas as well.
Because you've talked before that sometimes staying at the table by the relationship, you can maybe affect more change as opposed to pulling your money out of an investment firm or a company, and then you don't have the same kind of voice as a shareholder. So,
Exactly.
Yep.
Equity index.
Great question. And this is what we wanted to do with spend most of our conversation talking about account performance, what's worked, what hasn't worked, and we'll talk more about changes, which we may need to stop the recording for that. But love talking about it. Neil, go on. Sorry.
Yeah, the
I'm like,
equity-
Neil, you're gonna handle all of the account stuff, and he's like, I'm presenting with Karen. There's no way that's gonna happen.
This is wonderful. No, love the conversation. Kansas Equity Index. I mean, we've kind of touched on it, but the quarterly return was about 10.7%, just ever so slightly under benchmark, given all of the volatility in the quarter. We know that this has been a really profitable space to be invested in the last few years. In fact, 5 of the last 6 calendar years, we've seen returns in this space of 20% or greater. The only calendar year that was not true was 2022, when equities were down actually about 20%. And we don't market time, and I know this is just coincidental, but this portfolio certainly had some good timing there with the inception date of February of 2023, missed that down period of US equities when they were down 20%.
And as a reminder, we launched this fund for those investors that wanted maybe just a US equity only product. That's fairly inexpensive. So we launched the Kansas Foundation offered this fund for those investors. Also, let's just say you're invested in the balance fund, but you want more US equities, you could invest in the balance fund and then also have an allocation to this fund to increase the US equity exposure. So again, allowing investors to sort of tailor, give more optionality to the investors of the foundation. So this was one of the reasons for for making this a standalone investment option to offer.
And I want to just say, it says the word index. It's not tracking the index. I mean, so you said this earlier, but for those who are newer to the table, we're not using an index fund, but it tracks the index with the socially responsible exclusions. So does that make sense? So Anheuser-Busch is in the index, but not in this fund that we're using the word index for.
Yeah, it's not something you can buy at Charles Schwab or anywhere. Also, so the primary difference between the returns versus the fund and the benchmark is, one, it's net of fees. So we do include our fees in the returns, which the benchmark does not include fees. And then also it will be those companies we exclude: alcohol, tobacco, gambling, adult entertainment, and private prisons. So let's just say, like during COVID, when alcoholic beverages were doing really well, that was a hindrance on our performance because we were not investing in alcoholic beverages. So the difference between, again, the fund and the benchmark will be the exclusions and also the fees that we're reporting in the fund.
I think, Karen, the point to note on these, even though with the exclusions, the way the manager manages it is to try and match the characteristics and the returns of the benchmark. So from quarter to quarter, you will get differences in returns because of the exclusions, but over the long run, we expect that to be very little.
All right, let's take a look at slide 9. This is the last of the foundation accounts, the short-term investment fund. I've enjoyed speaking about this fund lately, given its performance. Quarter to date might not blow you away, a 1% return, but let's shift over to the 1-year return, and you see a 4.6% return for a 1-year period. Keep in mind, this is a fund with very, very little risk. So that is quite a healthy return at 4.6%. And we're only about a year removed from what I would call the glory days of the short-term investment fund, where its yield to worst was about 5.5%. So not quite there at the 4.6 here, but not that far off from all-time highs since this fund incepted in 2002. Of course, we expect the yields to go down as short-term rates come down. But your guess is as good as ours as to when that's going to happen. Could happen in September, could happen, they could begin the rate cutting cycle again in the early part of 2026. But what I do know is the Fed has been pretty steadfast in its dedication to being just very data dependent, not moving too quickly, wait to see the pass-through effects of tariffs. And they've resisted, till this point right now, they've really resisted the pressures they've received from President Trump to lower rates as quickly as he would like. Questions there? I will hop to slide.
Do we anticipate, and maybe this is for Dustin as much as anything, do we anticipate that some of our churches that hold funds there to reallocate as the return drops?
I think there's some of that. So in the event we have a correction, hypothetically, at some point in time, I think there's some of those dollars that might move into, more the balance fund or one of the equity funds.
That they held them there because rates have been high.
Yeah.
And that they may move.
I think more of the funds are invested there because that's the type of money that they have an account. So this is money for the roof that's going to need it in 18 months. So we've got it in the short-term income fund. Or they have money that's operating reserves, and this is a highly liquid, and it's making better or as good as you can get at our certificates of participation or a CD at a local bank. So, but those are the main places that we're filling those dollars with.
And this is a investment that's a subset of the foundation's investment.
Yes, correct. We have additional dollars of this type of fund in other investments that we had previously. So when you look at our reporting of short-term income fund, this is the bulk of that, but it's not all of it. Yeah.
All right, slide 10, we're looking at what we call a financial reconciliation report. This is a snapshot of year to date as the end of quarter two. If we look at that top line there, that total fund line, you can see the year started at about 73.4 million, ended quarter two at 71.5 million, as we spoke about. But make no mistake about it, there was capital appreciation. There was that line item there, the 4.3 million worth of capital appreciation. What we're seeing here is the impact of $6 million of net withdrawals. And almost all of that net 6 million that came out is attributed to the balanced fund, I believe, which took place in the first quarter rather than quarter two.
So, Scott, that's the kind of main thing that happened. Yeah.
And that was Ember Hope Youthville getting a contract for Sedgwick County, which required a massive investment in property, staff.
Yep.
Everything to gear up to care for an enormous number of kids in Sedgwick County.
Yep.
So, for my own clarity, looking down that center column, everything went in the right direction.
Yes, it's positive.
But the fact that we have less money is because we spent money on good stuff.
Yes.
Fantastic.
Good job. Good summary. Yeah, you always want that number positive in the middle. Yeah. And we strive for that.
This is
So-
for those of you not on the committee, and it was to get at that because occasionally we would see numbers go down and it's like, but I thought the performance was good. But this accounts for contributions and withdrawals, which we had not seen in detail a few years ago. And so this has been a helpful way to look at it.
Yep. And then on slide 12, I call this the Richard chart that Richard was working on with us. Richard, do you want to talk about this chart? Or, I mean, it seemed like it was a previous report that you had put together and then wanted us to sort of replicate it, which Neil did.
I was at the Kansas Health Foundation. I did all the reporting for investments, and this was one of the reports we did, and seeing how you can put a table down as what your performance is, but you don't know how volatile or what your standard deviation is. So we always compared, well, what's our benchmarks that we're using that we want to benchmark our investments against, and compared to the investments. So this is got like the Kansas short term, Kansas balance, Kansas equity, and Kansas fixed income. And to make it a little easier, they're all a plus, just as a easier way to track. You can see our equities kind of covered up with a blue dot, which is EFI, the international developed countries. But it's a 5-year snapshot. In other words, we're not too worried about quarterly and annual volatility and performance, but on a longer term period of 5 years, how are these different indexes and the funds we're using performing? And since we've just recently passed our 5-year benchmark, when we started at the end of the year, why it was easier to then start this new report. So to me, and 5 years from now, these dots will all be in a different place too. And I've seen over the years, we do have the aggregate and treasuries indexes are below zero. And there's going to be times that some of those stock indexes are below zeros, like when we went through 08 or 09 or 2001 and 2, 3 years in a row. While the 5-year numbers are going to vary, but it gives a longer term perspective than just talking about the last quarter or even the last year.
Yeah, so for some of our guests, you see the plus that's on the far left there. It's that purple right between the 2 and the 5. So that's the short term. Yeah, right there. Thanks, Dustin. So that's the short-term fund. So you'll notice it's to the far left on the x-axis, which is always so hard for me to say, x-axis. So I have to say it very slow, which this is the risk line. So it's to the far left. That means it's like the least risky where it's at. But also you'll notice it's one of the lower returns as well, which is what you would expect for a short-term investment account. So it's the least amount of risk, one of the lowest returns in the last 5 years. So it's kind of how you read it. And then if you look at the green or the blue at the top, maybe go at the way top, the blue. So that's highest return, but it's taking on a fair amount of risk. So there is that risk return sort of thing. It's rare that you will see something that's low on the y-axis and all the way to the right on the x-axis. So it's a way of kind of looking at investments that
I
way.
think Karen, just on this is a chart that my team looks at, when we construct a fund to understand the risk and return dynamics of the fund. So one of the things I want to highlight is that sort of that light blue cross, which is our fixed income fund, and then the little triangle below, which is Bloomberg US Aggregate Index, which is the benchmark for typically US fixed income market. And you can see there, and that's what we benchmark our fixed income fund to. And you can see that we're slightly less risky than the index, but we also have higher return than the index. And that's what we strive for when we put our funds together, is that dynamic, that lower risk overall, but expected higher returns.
Yeah,
Bob, for pointing it
think of this as just another tool in your toolbox for making informed investment decisions. It's highly customizable. So if there are indices you want added or removed from this, please let me know. I'm happy to make those changes. And the only Kansas account that's not showing up here is the equity index account, given that didn't have a 5-year track record.
And if you just look at the Russell 3, that would primarily be it.
Probably be right on top of each other.
Yep.
But so the thing to use this for is to look at it and say, oh, best fixed income is high yield. And the Russell 50 was the best stock to be in. So let's do that.
Let's not.
That is a lot, right?
Yeah.
But it also explains too, we're underweight the top 50, and that's been a hindrance of our US equity fund.
But when we look at that, it's important to understand, yes, we haven't gotten that return. We haven't necessarily had that risk either. And so there's a trade-off.
Or the benchmark seen a little bit more risky
Yeah.
because of the higher concentration of those names. So it kind of helps explain the performance as well, too.
As an outsider, to me, if you could color code it in such a way that the Kansas short term is purple, the benchmark is purple X, the benchmark for the Kansas short term is a purple circle or something, so that you could correlate what the benchmark is versus what for that particular fund.
Yes, let me jot that down.
And I don't know if it's circles and pluses or whatever, but somewhere you can say, oh yeah, this is the benchmark for this.
And there are a lot of benchmarks on here that we don't.
Exactly.
Right, but
Yeah.
We're reporting a lot more benchmarks than what we're necessarily
Yes.
following.
Yeah.
yes,
Yeah, it's asset classes within the fund, but not the fund's benchmark.
Yeah, I think so. Yeah, the next few slides are just talking about market performance that I think both Neil and Karen have alluded to as we're discussing performance of the fund. But it's just like the chart, but it just clearly shows some of the things that are going on this year. And that mainly was in the first quarter. You had a lot of negative equity returns. And the second quarter, you can see the blue bar. It's done really well. A lot of what happened in the first quarter was, some of those mega cap names, some of the tech names just, imploded. Once the DeepSeek announcement came out, we just saw the market take a dive. We saw a lot of negative returns coming into the second quarter. With the whole Liberation Day, I think there was a little bit concerned that actually did see a lot of negative market movement on the second when those things were announced. But since then, surprisingly, the market's just rebounded. And we've seen some really strong performance in the US equity market, once again being driven by some of those Mag 7 names that, we talked about, I'm sure, in the past. So the blue bars just represent the return in the second quarter. The orange bars are year to date. I think that what's notable is the international market, which is denoted by MSCI ACWI ex-US IMI. So that's what we use for international market performance. You'll see two lines there, one with the USD, one in local. So local is just the local currency return. So that is really the true performance of the companies in their local currency. So you see, the local returns, the returns are about similar to US companies. Where you see the big difference is in the US dollar, and that is due to the weakening currency. So about, with the dollar declining by 10%, that had a big impact on international returns for US investors. And you can see that's where most of that, the outperformance in international is coming from, is because of currency. And then on the fixed income markets, where it starts, go back.
Sorry.
Starting at Universal, XMBS, US Aggregate, and Global Aggregate. Those are three fixed income benchmarks. I think they're performing as we would expect. What is notable is, as Karen alluded to earlier, that global bonds did really well in the second quarter and so far this year. And then the next slide is just breaking down some of the sector performance in the US and non-US. And you can see outside the US, it was, widespread, strong performance. We have positive results in all the different sectors of the market. And the US side, though, if you take a look, it's a little bit more mixed, and it's still very much driven by those magnificent 7 names, which are in the information technology and the communication sectors. So you see the sort of the two biggest bars are the ones where the Mag 7 names are. And so that's a story I think that we've been seeing for the last few years.
What's the energy drag?
Energy.
I mean, oil, price of oil.
Yeah. Mainly oil.
Drive the price of oil down, it's gonna drive the price. Internationally, it's not dragging, and yet US it is, that's why I was. Because I think of oil as more of a global commodity.
It is, but there are other maybe just users of energy also in that too, or refiners. Some of the oil companies, like I think like the Total or that are based in Europe, I think they're a little bit better.
Was that impacted by tariffs at all?
Yes.
Yes.
And that's also.
That was my.
The change.
I asked a question where I knew the answer to, and they said you should never do that, and I just caught myself doing that.
Well, a lot of it is tariffs. I mean, a lot of the
Oil. The pullback of support for those things has hurt those non-oil based energy.
So the other question I have on the international space is, does that have the adjustments? Does it net out the effect of the US dollar dropping 11% in the first half of the year? Because if it doesn't, that's another reason why energy would look so much stronger.
Yeah, this does not. This is in US dollars and not local currency.
That would be a good move as well too.
I mean, those are the two things. I was wondering about the tariffs, but then I was wondering also about our swing from the administration really putting a strong refocus back on fossil fuels. And if that has caused us to drag the international.
And part of it too is some of the
energy.
companies on the US space are hurting. Shell is not profitable at $65 a barrel.
Mhm.
Shell needs $75, $85 to really, be. And so what you're seeing is the rig count in the United States has dropped substantially. So the US companies are becoming a lot less profitable. With the whole drill baby drill, it's really, Aramco is wrapped up in Saudi, Saudi Arabia is, ramped up to lower the prices, but it's hurting the US. Sorry,
No.
That's okay. It still amazes me, sort of like the profitability of oil, because I used to imagine natural resources fund way back when, and we're talking like break even is like $13 a barrel. So that's a long time.
Such a change. When I got my license, gas was 99 cents a gallon, I remember.
I want to know what it was.
Well, I have a soon to be driver. So I'm like, oh gosh, like
Yeah.
my dad gave me $10 to fill up the car.
Buying up at the pumps.
Yeah, my dad gave me $20 or $10 for gas, and now I have a 15, gonna be 16-year-old. And I'm like, what do we give her? Like a 50, 100 to go?
Make it work for it.
Yeah. Yeah, good luck. Good luck with that one.
So, and this slide just shows the different performance of the different sectors within the fixed income market, and really where we see the strongest results were in the riskier segments of the market. So really the high yield, the emerging markets, the global markets, and that had an impact on our fixed income performance because we do have overweights to those areas of the market. So the investors, I think, were a little bit more open to taking on risk in the fixed income markets in the second quarter. I think they still, see signs of global growth, even if it's slower, it's still positive. And so fixed income markets, fixed income investors are just a little bit more resilient, and we see that in the numbers. And, I think, currently too, in our fixed income fund, we're going to always be underweight in treasuries because we allocate to the other what we call the plus sectors of the market where we expect to add more value.
And then on 16, I know we've talked a lot about the performance. I think at this time is when we kind of wanted to dig in more to like what's going on primarily in the US equity fund. But I know before we stop the recording, I wanted to see if anyone has any questions.
Hey, do you want to talk about, we did some analysis on the 5-year, the longer term performance on US equity.
Is it included?
There's a slide here, yeah.
It's
Oh, okay.
It starts on slide 20.
Okay, yeah, let's go to slide 20.
I think this is one of the questions that we've had questions on, like what's been driving the performance. So we just did an attribution just to look at the fund level, what's been going on. And you can see, yes, we've underperformed, and this is a cumulative return. So this is the entire 5 years that, we've been underperformed by 25% in 1 year. This is over the 5 years. And you can see a lot of it has to do with the underweight in the Mag 7. As Karen mentioned, those 7 names comprise about 35% of the index. I think, we have a very diversified portfolio. It's going to be difficult to be overweight in 7 names because that's not prudent in portfolio construction to have that much concentration in your fund. And so much of that is due to our desire to be a little bit more diversified. And because, we're underweight in those Mag 7, we're actually a little bit overweight in mid cap and some of that. And that also hurt performance. So despite the underperformance, we did have some positive contributions. And we had this actually stock selection in Mag 7. So there are certain names that we didn't own that actually did contribute to returns. So it wasn't, yes, we were underweight, but the ones that we chose to own actually did help us. We did have an underweight to large cap. We've talked a lot about our overweight to small cap. Even though we had that overweight to small cap and it hurt us, our managers actually did a really good job in outperforming the small cap benchmark. So they were picking the right stocks within small cap, and that added to our performance.
Yeah, I think in the US space, especially the last 5 years, like diversification was really no one's friend. So the more diversified you were outside those top 7 names, top 50 names, the greater the impact it had against more diversified, the more impact it had on the performance, which we try to be. Diversification is key for us. And we'll talk more about some of the changes we're doing in the portfolio. But yeah, like Wah said, our investment managers within the small cap space were successful. They did outperform. They were picking the winners within the small cap space. It's just having the overweight to small cap relative to large cap was an impact of the portfolio. And same with large cap, like the names that we had in the portfolio positively contributed, but the weighting of large cap within the fund negatively contributed to the overall fund performance.
And then slide 25 is a similar analysis we did with their National Equity Fund to understand what's going on there. We don't have as much of sort of strategic biases there, but as Karen mentioned earlier, with the managers that we did use, I think they were, investing in ways that actually grew, like they started overlapping a little bit more over the years. And so that did lead to some distinct biases in our fund that we were, intending to have.
unintentional.
Yeah. And so when we're looking at what really drove returns there, it's really because value actually has done well outside the US. And if you see how our fund is allocated, large value, we are very underweight in large value, or underweight large in general. But in the chart with the bar chart and the more colorful ones, that just has segments of the index and how they return. And you can see across the board is the value benchmarks that did well. And that's where we had less exposure to it. Any questions?
And then there are slides in here. One of the things too, if you want to go to 28, we are launching a international index fund. This is something that has been in the works. Again, we want to provide optionality to our clients, and give them, like we did in the US space, we want to also offer a index product as well. It is going to be benchmarked to the MSCI World ex-US. So the differences between our fund and this, other than not having active management, is it will not have emerging markets because of the benchmark.
So no China.
No China.
Can we skip back to page 18?
Yes.
That's
Sorry about that.
important too. It's important that Dustin originated for one.
Oh, yeah, thank you.
And, I always wonder as we go through those reports, well, we've redone our allocation. What does the total look like? Because we want to don't want to make that big a bet to be underweighted the mega cap stocks. So they've done this new report that Dustin had used, that you can see we're only 12% underweighted instead of 22 of the mega cap.
Yeah, if you look at the far right. So how it looks is each of the allocations, the target allocation currently within at Wespath, our Wespath US equity fund allocation, and then the benchmark. The differences in that column is between the Wespath fund and the benchmark. But one thing we added on the right was, now that we've redone the allocation, as Richard mentioned, what is your overall in your US, only in your US equity fund, or in your equity fund, not your balance fund. So in your equity fund, what is your weighting to these various allocations? So yeah, as Richard mentioned, the fund's 29% mega caps, you're 39% mega caps. Large cap, you're pretty much in line. Small and mid cap, it's 42% in the fund, you're 35%. So again, part of the work we did to minimize the overweight with the reallocation. So you can see that. And then obviously private equity, private real estate is very modest, but it's more modest in yours because we added in the benchmark, the index fund.
Does that make sense to everybody? Kind of shows us what we're actually doing of the, compared to the Russell 3000.
Thank you, Richard, for pointing that out. I forgot that we did this. So thanks for reminding me.
Are we the foods here?
It is.
Looks like she's still plating it. And maybe we'll just touch on briefly the fixed income funds. Again, we're not making changes. I shouldn't say like major changes. We're always watching the funds. If you go on slide 29, we talked about this fund a little bit earlier. You can see, the fund is allocated and how the benchmark is. So the fund's underweight US Treasury and government bonds in lieu of having an overweight to high yield. And obviously our intern, and then having an overweight to non-dollar denominated bonds. So high yield, non-dollar. And then we also include our positive social purpose lending program in this. This is the internally managed program that provides helps finance affordable housing and community development in disadvantaged areas. So we'll help provide financing. Like as an example, we helped provide, so there's an area in Texas, Socorro, Texas, where there is a large veteran population. One of the things that this population needs is in need of like housing, mental health services, and so forth. So through this program, we helped finance an affordable housing program that provided housing specifically for veterans. We're not doing direct lending. We work with intermediaries. It's a smaller portion of the portfolio, but this is where we really focus on providing that positive impact. So impact to a community and also providing a positive return to our portfolio. So I always say it's the practice of doing good while earning a market rate of return in the program. So that's where that allocation to community development loans is. So really what's contributed to the fixed income fund performance has been the overweight to high yield and that non-dollar exposure. And just being underweight treasuries and government bonds has a positive impact on the portfolio.